morning, everyone, and welcome to the Mortgage Bankers Association of Mississippi panel discussion from the Underwriters' perspective. I'm your moderator for today, Sheila Thomas. This year is off to a great start, and we would like to first thank our wonderful 2021 partners, Acronet for being a business partner, Liberty Financial for being a Delta partner, and our Magnolia partners, Mississippi Home Corporation, and Renfro Marketing. 2020, I'm sure we all can say, was a year like we've never experienced before in the mortgage industry, with extremely low interest rates, record-breaking originations, and of course, COVID-19. But here to help us navigate through this maze is our distinguished panel of experienced rock star underwriters. Today we have with us Jennifer Johnson with Bancorp Sal. Hi, Jennifer. Janice McKinnon with Keesler Federal Credit Union, Regina Richardson with Trustmark National Bank, and Nan Watkins with Citizens National Bank. Welcome to our underwriters. Now, we would love to hear from everyone, so please feel free to send in your questions to our panelists via the chat box. Caitlin will be monitoring the chat box, and we'll try our best to get to your questions as they come in. So guys, let's get started. Everybody's all anxious. First, we would like to hear from each of you. Please tell us what type of challenges or issues that you guys have been experiencing over the past year, and how you've been overcoming these obstacles, especially underwriting during this time of COVID-19. We're going to start with Jennifer, and then we'll have Janice, Regina, and then Nan. Go ahead, Jennifer.
Good morning. I'm really excited to be here. I'm kind of nervous this morning, so y'all just bear with me. I hope everybody's doing well today and survived our crazy weather from last week. I don't know about y'all, but last year was rough for me. 2020 certainly presented us all with some unique challenges that we're still struggling with today. Overnight, a lot of us went from getting up and going into the office every day to setting up home offices on our kitchen tables. Some of us right next to our children who had to switch to online or virtual learning. Trying to balance our professional lives and our personal lives became much more difficult when they collided in such a dramatic way. We're having to deal with distractions that we rarely had in the past. I now have 2 furry feline assistants that love to walk across my desk and steal my office supplies. And if you happen to see them in the background, just say hi and ignore them. They'll go away eventually. The COVID pandemic completely changed the way we do business. We've had to learn new ways of communicating, holding meetings and training sessions such as this. Lots of us now use Google Meet or Zoom. And for those of us who are not as technologically advanced, that would be me, this has really presented us with its own unique opportunities for growth. We've also been faced with a multitude of COVID overlays from the different agencies and investors. Documenting and calculating income has become significantly more complex. Some borrowers have been furloughed or had their hours cut, so determining if their income is stable and consistent is more important than ever. Self-employed borrowers have always been a bit more involved, but the new COVID overlays make it even more so. Small businesses have been hit hard by the pandemic, and we're still struggling to keep up and how to best help them. Trying to document files to these new overlays, heck, sometimes trying to understand the new overlays and how to document the file has been problematic. While we can still rely on DU or LP for some guidance with regards to documentation, it's imperative that we know and follow the COVID guidelines and overlays required by the agencies, lenders, and investors. And if all that wasn't enough, now we have the new application that's rolling out next week. With all the changes we see on an almost daily basis, I think one of the best things we can do is take as much training as we can and consult agency investor guidelines often. We can no longer rely solely on DU or LP for required documentation. Our MI companies offer a lot of invaluable training to us free of charge, and I urge you to take advantage of that. Also, Fannie Mae has a list of frequently asked questions for their temporary COVID guidelines that they update regularly. And we can't forget about Ask Polly. She's invaluable. I think we can all agree that mortgage banking is an ever-evolving entity, and we can never stop learning or allow ourselves to become complacent. Our goal is to help individuals get into homes and stay in their homes. but also we have to ensure that we make quality loans that meet agency and investor guidelines. This is not an easy job, and it's not a job for the faint of heart, but it's an incredibly rewarding job, and it's most certainly never a boring job.
And just the biggest challenges, like Jennifer has said, is the change in our work environment, working from home. I don't have an Ask Polly on my computer, so I have to start researching those guidelines, picking up the phone, calling Freddie Mac if I've got a question that I need further clarification on. And all of that is very time consuming. Like Jennifer says, we cannot just rely on LPA findings. We have to dig deeper on these files. We have to document these files. And all of that, does take additional time. What I've found is the loaner really communicate with the borrower. The process, our borrower needs to understand that the process has changed. It's not just like purchasing a car where you come in with a pay stub. It's more complex. And I think if our borrower understands that, they'll understand the additional time that it's taking right now to underwrite these files and the additional requests that we have for follow-up documentation that gets required. If we can let our member and our borrower know, then I think that would help a lot also. I've not started working on the new application, so that will be probably quite stressful next week. So that's something new that everybody's going to be challenged with. If you underwrite USDA loans, we've got an additional challenge with USDA loans where their system is changing effective next week. So it's changing guidelines and having to take the time and re-verify if something is changed. That's been a big challenge. We are down here on the coast. The casinos got closed for COVID. So that was a challenge with people being furloughed. The casinos are back open. I did enjoy when we could get an LPA for an appraisal waiver. That was very nice. But then the coast got hit with several storms. And so then we had to do inspections. So it's just been like Jennifer says, it's just a whole new year. It's a lot of changes for us as underwriters. It's a lot of changes for loan officers, but it's a lot of changes that the borrowers need to understand, that this process could take longer and we're going to be asking for additional documentation that they might not have ever been asked for before when they did a refinance or a purchase.
Good morning, everybody. I kind of thought that I was going to be given 5 minutes to tell you everything I knew about COVID requirements, and I decided that's 4 minutes too long. What I would like to emphasize today is that whatever we say during this call today could be invalid as soon as the end of our sentence, because the industries are changing. If you're one of the ones in your office that's responsible for keeping up with guidelines, you have a huge job, and all I can say is good luck, because we're getting notifications of changes and requirements daily. They're extending the requirements, and sometimes when they say they're extending requirements, they're tweaking them a little bit in that extension. The agencies have different timelines for these requirements, and by the time we get to the end of June, they'll probably be extended again. I would say that Fannie Mae and Freddie Mac are probably the most robust with their changes, and they're probably the clearest with their changes. USDA decided that next week they're going to have all kinds of changes with Chapter 6, Chapter 9, GUS, everything else. Probably the best advice I could tell you is to put the links to all the agencies on your desktop. And before you answer any questions, go out there. I know I have a steady stream in my office a lot of times, asking questions. Well, what's required here? What's required here? Before I answer any questions, I always go out to whatever's the most current and I look it up. I even subscribe to some industry, I guess, vendors where they provide charts and different things like that on what's required. I've gone out and looked at those, and some of those aren't even up to date. So your best practice is to go to the guidelines. When in doubt, go to the guidelines. The only absolutes I know that are that are valid anymore is that God's good and hell's hot. That's all I know anymore. That's just an absolute. Outside of that, everybody is different. Every agency is different. If you sell to in the secondary market and you sell to investors, they're different too. So I reiterate what the other ladies have said on this panel, that it will take a little longer. And Janice and Jennifer both stressed one thing, and I would like to emphasize it. The best thing to do is to once again communicate with your borrowers. I think for a long time we got lazy when we got online applications and we stopped actually talking with people and with our customers. Realtors, customers, they don't know all these changing guidelines. And it's best to prepare everybody up front, because when it gets to underwriting, everybody's ready to close. And then we have that wonderful job of saying, well, you might have to delay the closing because here's what this newest requirement is. And that's never pleasant. I know we underwriters may have a reputation of liking to do that, but we really don't. Our goal is to get as many people in houses just like everybody else's is. So we want to do this. Reading is fundamental. I told Jennifer she could use that. I say reading is fundamental. Learn to read those updates and learn to read your DU and LPA and your GUS. Read it in its entirety, because in there, more than likely, it's going to refer to something, refer to this mortgagee letter or refer to this lender letter. So read, take time and read. It will help with customer frustration on the end. So, thank you.
Hope everybody's doing well. I don't know how much I can add to what these ladies have already said about the struggles that we've had due to COVID, with all the overlays that have impacted our underwriting of files. I do agree that you need to know your guidelines. You need to read up on the changes that are coming out every day, whether it be updates your underwriters are sending you or your bank sends you, signing up for your investor updates. We talk about communication with the borrower. I think that's one thing that with our new URLA, that's going to solve some of this, because it's got so many extra little buttons you're going to have to click and answers that you've got to answer. That you've got to have detailed conversations with your customers. Taking that telephone application or internet application and just running with it, not going to be as easy. And some of the testing that we've already done, we have found that just leaving the phone number off of it, date of birth, you can't even run DU and get an approval. You've got to go back and re-enter it and make sure that information is in there. So as you get those applications, you're going to have very detailed conversations with your customers. And your customers, even though they don't understand this process and all the changes, they're going to be a lot more appreciative if you take those extra steps on the front end and spend that detailed time with them than coming back 100 times throughout the process. I need to ask you one more question. I forgot to ask this. Do the homework on the front end and have those detailed conversations. I just think it's going to be very important as the years goes on. I don't think we're nowhere from being over COVID. And I don't think these COVID overlays are going to go away when COVID goes away, because the impact that it's had on our self-employed borrowers, that may be around for quite some time to come. Businesses have been impacted due to loss of income and not operating. And so I think we're going to be dealing with this probably all of 21, just like we had in 20.
All right, thank you, ladies. We do have one question in the chat box, I think, so far. And they want to know, where does Regina subscribe to get her information?
I subscribe to Mortgage Currency. I know there's a lot of them out there, but I do subscribe to Mortgage Currency. It's very easy to navigate. They have really good charts and checklists, and then they have income analyzers. Also, they have good articles. So I subscribe to it. It's inexpensive, maybe $40 a month, I think, at most. So that's where I subscribe. Now, I will say, there's a lag between when the industry updates and when they come out with new charts and checklists. So you have to be careful of that. And then, there are some gaps in all of what they tell us. Because, it's hard to put everything on Lender Letter 2020-03 into a simplified chart. So that never replaces going to the guidelines, but it is a quick aid, and it does provide a lot of aids that will help you. And then in a pinch, I guess you'd say.
Gotcha. All right. Well, I'm going to ask some questions now, and I'm going to direct them to one person, but please feel free to chime in if you have additional information to add. This is one of the questions that actually came in through registration. What about in calculating income, especially with a W-2 employee who, let's say, we're receiving a whole lot of overtime, but then it was kind of declined a lot during 2020 due to COVID-19. How would you guys handle that? And let's start with Nan on that one.
Me?
Yes, ma'am.
You definitely have to consider that reduced income. If it's not steady and you don't feel like it's going to continue, you can't use it for qualifying. The guides even recommend that you, or tell us that we need to use the lesser of those incomes for qualifying. If they had a lot of overtime in 2020 and they hadn't gotten any in 2021, I probably would, as an underwriter, wouldn't even allow you to use the overtime for qualifying.
Anyone else have anything else to add? Or
I'll say something. I think we all need to keep in mind that we are trying to have a sustainable borrower. What we don't want to do is put a borrower into a house that they really can't qualify for, because then later on, if they get behind in the payments, or if God forbid they have to go into a modification or foreclosure, that could affect them for a long time. We want to have sustainable borrowers. So what everyone needs, and I've had many questions. Well, can I take out the part when they were furloughed? I don't think there's an underwriter on this panel that hadn't had that question answered. Or can I count the unemployment that they had during that time? Remember, just keep in mind, we want a sustainable borrower. So if that borrower had some time off, the income that they have needs to be adequate. If they ever have this again, needs to be adequate to maintain that house payment. And if you keep that in mind, then you're going to be conservative about what you count.
is it safe to say that most underwriters are conservative when it comes to income? And this is just a general question. So, Jennifer.
Yes. Okay.
Oh, Janice.
I would say yes. I'm going to look at that. I'm going to look at that income, and if I can qualify them on base only, I'm going to qualify them on base only. I'm not going to start hunting for, the bonuses and the overtimes and commissions. If it goes with the base, I'm going to use that base income.
And I'm the same way. If I get a file in and they've used overtime and bonus, and I can see that they don't need it to qualify, then I'm going to work on that file with just base only. That way we've got a much more like Regina said, a sustainable borrower.
Okay, great. Now, Regina touched on this with her last answer about unemployment. Can unemployment benefits or income, especially the funds received last year with the CARES Act, can that be used for qualifying for a mortgage loan? Yes or no?
No, no,
Yes,
it cannot.
No.
No. The guidelines specifically say it cannot be used. The only unemployment that can be used is if it's typical for a seasonal worker that is unemployed each year. But you cannot use this unemployment currently due to COVID.
Good to know. Now, on to what we've all been struggling with, the self-employed borrower during COVID. How are we calculating income for that small business owner? What type of documentation as far as tax returns, the P&Ls, the profit and loss statements, bank statements? And let's see, let's give this question to Jennifer.
Okay. Generally, 2 years business and personal tax returns are going to be required, but DU or LPA may only require 1 year. And if Fannie Mae does so, we can do that. Then we're also going to have a profit and loss. And if it's an unaudited profit and loss, 3 months bank statements. There's a lot of great tools out there to help us analyze those tax returns and the profit and loss. Our MI companies have great cash flow analysis, and Fannie Mae's got a lot more in depth now with what they're requiring us to review as far as the profit and loss. I know I've had to take a lot more training to understand profit and loss statements because we've never had to do that in the past to the depth that we have to do it now.
And you talked about bank statements.
Mm-hmm.
Okay, so you do have to tie the bank statements back to the
Yes.
profit and loss and make sure the
Right. Make sure that the deposits that are going into the bank statements reflect the income that we're using.
Okay. And what about funds from the Paycheck Protection Program? How does that affect, number one, let's say income, or is it counted in income, or is that payment, I think some of it's been forgiven or whatever, but is it included in your debt to income ratio? So Regina?
You just gonna ask me?
I'm sorry.
Like I said, each agency is they're different. Fannie Mae and Freddie Mac are pretty concise about what they say. FHA and VA and USD haven't provided a whole lot of guidance. So I typically apply what Fannie Mae and Freddie Mac say across the board. Those, if you're a self-employed borrower and you had to get a loan to continue your payroll, that's not always a positive thing. It cannot be. I don't count it as income. I don't know about everybody else, but I do not count it as income, and we do not allow it to be used as assets because that is an unsecured loan, and unsecured loans are typically not used. As far as in the debt to income ratio, I would have to ask for a copy of the note to see kind of what it says. I haven't had that come up a whole lot, to be honest with you, and I'm just going to be. I'm just going to be transparent. I haven't had that come up a whole lot. If there is a payment attached to it, then we have to look at it. If not, then sometimes we apply the 5%. So it just kind of all depends on what documentation you provide. I will say this, and I did not say this before. Provide documentation to underwriters. The more you provide to us, sometimes the more you provide to us, I know a lot of times you'll think, oh, I don't want them to know anything. The more documentation you provide, the better explanations you have in the file. Sometimes then we understand what you're trying to do, and we can kind of go into and see what you're trying to do. But I do not use those payroll loans as income nor assets.
I think that's a consensus across the board, right, guys?
Mm-hmm.
Yeah.
Okay.
Yes.
Another question has come into the chat box. Any current appraisal changes? And let's see, let's go to Janice.
Not that I have been aware of. The VA was quite lenient initially with the appraiser calling the client and then just doing a desktop but that near the end of the year slackened off. Right now, I'm finding that most appraisers are actually going into the home and doing a normal appraisal. I've had very few that are coming through where they're just doing a desktop now.
Great deal. All right. Let's see. Let's talk about gaps in employment. Let's go back to that because I know that there are some specific rules as it relates to gaps of employment of over 6 months or so. Let's go to Nan.
Okay. As far as Fannie Mae guidelines, we definitely have to consider those gaps in employment and look at how it has affected their income that we're calculating. The gap or the reduction in income cannot be excluded from the calculation, and the year-to-date income must be going to continue to be calculated over that entire period of time. So we do have to look at that and make that part of our consideration in calculating the income.
Okay. All right. And anyone have anything else to add as it relates to gaps in employment? Let's talk about student loans. Dreaded student loans. I know the guidelines for that differ based on the loan product. Let's see who. Let's go to Regina. It's only 4 of you. Have this ready.
As long as you don't ask me about forbearance of mortgages, I'll be okay.
Okay, great.
I haven't seen a whole lot of, and maybe I'm wrong on this, but I haven't seen a whole lot of changes on the forbearance of student loans. It's kind of like it's standard documentation. If your loan is in forbearance on a Fannie Mae loan, you know, Fannie Mae hasn't recognized a forbearance or a deferment for a long time. You still count either the IBR payment or what's on the credit report or the 1%. Same with the other industries. You know, it has to be, if that industry does allow for, or that agency does allow for a deferment or a forbearance, it has to be 12 months from the note date. So I would go, I haven't seen a whole lot of changes in that. Now, you know, y'all may tell me that's different, but we still go by the regular guidelines that if it was in forbearance or deferment, it has to be for 12 months. And then you count whatever that payment is, if that industry allows you to not count a payment.
Okay. Anybody else want to add anything?
I would just add that if it is, you're trying to use an income-based repayment plan for calculating the payment, you've got to get the documentation from the student loan company to show what that IBR payment is. The back.
Okay.
Also, I have seen, and we've had some issues, and I'm going to throw this out to the other panelists to see how they handle it. I have seen several of the COVID forbearance or the CARES Act forbearance payments or documentation come in that says after the forbearance, the payment will be recalculated. And we've asked for documentation to show that before, you know, what payment was before it went on to the COVID forbearance. But if it was on an income-based repayment and the payment was either zero or a low amount, have y'all continued to allow that? Or with that verbiage on there that says it will be recalculated, are you making them count 1%?
I've either been going with worst scenario, or I've been looking at that trending chart that is on the credit bureaus. And if I'm calculating the payment based on their guidelines for the forbearance, if the trending chart is showing a higher payment, I've been looking to see whether they qualify with the higher trending payment to do worst case scenario.
Guys, go ahead. Mm-hmm.
I haven't had this come up a lot, but the ones I have seen, I've ended up using the 1% payment for the student loans.
one thing you have to look at on the IBR, all of those payments at some point in time, they're going to have to requalify each year. They have to reprove what their is. So that payment's going to continue to change.
So worst case scenario. Okay, and we do have another question through the chat box, and it goes back to income. So let me, it says, with MI going to risk-based pricing, do you still only use base income if they qualify, even if it increased the MI premium, since the DTI is a factor, I guess, with the MI? So to help with the MI, would you then include maybe overtime or bonus income?
I'm going to say it all depends on what documentation you've given us.
Yeah.
Mhm.
So it goes back to documentation. If you could show that they're back at work on a Fannie Mae loan and they've resumed that, as long as, I would still use the 12 months average, but I mean, it all depends on what you've given us, what you've provided us. If that employer goes back and says, yeah, we had a short furlough, but we're back up to, normal operations and it's back. If that average would be would help them, I would consider it, but you got to document it.
Mhm.
Documentation. All right. This question is for Jennifer. How about documenting earnest money deposits? That question also came in during registration.
Typically, we have to have a canceled check. If we're talking about Fannie Mae, if any part of that deposit is being used for their minimum required contribution, then we've got to verify that the funds are from an acceptable source. And we have to have receipt of that deposit, which is usually a copy of the canceled check.
All right. Anybody want to add anything regarding earnest money deposits?
Add that if you're, because sometimes what I see is that when I'm underwriting the file and I've looked to see when the earnest money check cleared, it may have cleared, but it was after their bank statement cut off that we're using for assets. And if it did, I'm going to make them reduce their assets by the amount of that earnest money because it cleared after the fact.
All right. Okay, a follow-up question from the chat box. Is that all, just a canceled check, or is a copy of the bank statement, which you just talked about, a transaction needed without needed, or printout needed, and you just said that it is?
Yes.
You just said that it is. Okay, next question. It is about the COVID-19 forbearance. How does it affect a borrower's ability to purchase another home? Let's say the current home that they're currently living in, they went through a COVID-19 forbearance, and then they're looking to buy another one. How does that affect? And Janice, this one's for you.
If they brought their mortgage up to date and they've made those mortgage payments and they're out of forbearance, then based on what I've been looking at, they've brought those out of it. They're back on track making payments. It should be okay.
Okay. And what about refinances? Follow up. Refinances for a mortgage that has been through the COVID-19 forbearance.
Yeah, they can do their refinance. They have to meet the Freddie Mac guidelines. They have to be out of the forbearance. They have to have met their obligation with that forbearance, and they need to have made at least 3 consecutive mortgage payments before they can do their refinance.
Okay, great.
I'm going to address the VA IRRRL situation. We had to actually reach out to St. Petersburg to get some clarification, because the last guidance came out, you have that seasoning requirement that you've got to consider. And so there's kind of two different guidances on that. If they made the 6 payments prior to going into forbearance, then when they got out of forbearance, they could add the delinquent payments back in and any late fees or anything like that into their VA IRRRL. But if they had not made the consecutive 6 payments prior to that seasoning, then that seasoning did not count. I mean, those payments did not count towards the seasoning. So they had to make 6 payments after the forbearance. Well, even though the circular said you could add those late payments back in, I don't know of too many servicing lenders that's going to allow you to be late on that forbearance during that forbearance and then have 6 more payments before they start foreclosure proceedings. So we ask VA about that, about adding those payments back in, and you really have to catch those payments up. Each lender has their own rules, but for Trustmark, on a VA IRRRL in which they did not make the 6 payments prior to going into forbearance, they will have to bring those payments current and then make 6 payments. So I wanted to point that out too. That VA IRRRL is a little tricky. You need, if you're selling in the secondary market, you need to check with your investor to see what they say. But even though the circular says you could possibly add those in, you need to bring those payments current if they did not make 6 payments prior to their forbearance.
Yeah, same with Freddie Mac says no, missed payments during a forbearance may not be refinanced. So.
Okay. I have another question from the chat box, and it's again back to income. Income seems to be very popular. How do you handle contract jobs, like a traveling nurse who's an RN at a hospital for 11 years, but for the past 2 years has had 6 different agencies, I guess, with a break of employment of 1 to 2 months at a time during the last 24 months. So traveling nurses with breaks of employment for 1 to 2 months in the last 2 years. And let's see. Let's go to Nan.
Traveling nurses can be difficult. I would want to know, are they showing it on their tax returns as Schedule C income, where they're basically self-employed working for all of these different companies? And we would need to look at the history and what they reported on their tax return. If they have a 2-year history and the year to date is supporting what they've had over the 2 years, I would do those. They haven't had 2 full years on that travel nurse job, I would not want to use it.
Okay. Anybody else have anything to add with that one? Another question through the chat box. What about underwriting jumbo loans? Does anyone underwrite jumbos at all? Okay, Regina.
I don't.
It depends on your investor once again. When I say I underwrite jumbo loans, Trustmark we have a portfolio product line. And so for our retail side. And so that's pretty much what we go by is our own internal guidelines. It would, for other investors, it's just, once again, you have to consult with your investor guidelines. We apply pretty much the Fannie Mae standards to our portfolio products if it's not specifically mentioned in the guidelines. So pretty much Fannie Mae is what we go by. But if you have an investor, you got to check their guidelines and their overlays, and those change all the time.
Okay. All right. I have another question, and it has to do with using retirement assets for income. It said, if using retirement assets for monthly payments, client has disbursement set up, confirming no longer reduce assets accounts by 30%. Also, if client, for example, has 1 million account and they are taking 200,000 down for down payment, but still have plenty to support their 36 months of continuance based on monthly disbursement. Are we okay? I'm reading.
It would depend on their loan product. If it was a refinance or a purchase, it cannot be a cash out refinance. There's particular age regulations for the borrower. They would have to be 62 and older, and we would have to get documentation in the file, and again follow the, well, in my case, Freddie Mac guidelines. So it would depend on the particular loan. If they were looking to do a cash out refinance, no, you cannot use assets as income.
Okay. Anyone else? Okay. And I think this person was also trying to confirm whether or not you reduce the asset by 30%. Confirming, they wanted to confirm if you still did that. Reduce the asset by 30%. The retirement asset.
The amount, I've actually pulled a guideline here for you to determine the established debt payment to income ratio, just seller net eligible asset divided by 240 months. The amount of the net eligible asset is calculated by subtracting the following from the total eligible assets. Any funds, if the borrower is going to liquidate some of those funds for closing, so any funds required to pay by the borrower to complete the transaction, example, down payment and closing costs. So you would have to subtract that portion also, but it does say net.
Okay.
And I will say, I know that Fannie Mae has a really good chart in their guidelines that you go by. And if you follow that chart and just plug in numbers, you should be able to determine what you can use for qualifying income.
Fannie Mae COVID guidelines do state you need to use 70% of that statement balance. And if you're having to take money out of that retirement account for closing or down payment or reserve, you've got to prove liquidation of it. And that would have to be subtracted away from it.
Okay. All right. Another self-employment income question. How would you handle self-employed borrowers if their income on the P&L is less than what's on the tax returns? Okay, Jennifer?
These are really, it's like on a case-by-case basis. You're going to have to see how much more documentation you can get. Can you get more bank statements? Instead of doing the 3 months bank statements, you may need to get 12 months bank statements. But you're going to most likely have to use the lesser of the income. You're not going to be able, if the income on the tax returns is higher than the income reflected on your P&L, you're going to have to use that lesser income. But in order to do that, you may need to make sure that that income has stabilized. And one way to do that would be to get more bank statements. And that's just one way. It's a case-by-case basis, and depending on what type business it is. So there's a lot of considerations to look at there.
And let's see. All right, another question. Many times originators minimize the 1003 to keep the file thin. Example showing borrower with zero assets if not needed to receive an approved eligible, through the automated underwriting system. Do underwriters prefer to limit the documentation, or would you like to see the assets that the borrower has to make you feel better about the file? And that can be, let's see, Regina.
I'm glad to take that one. Bank statements tell so much about a borrower. Now, I've been doing this long enough I remember when the casinos started in Mississippi, and we used to say, "Oh, they go to the casinos too much. We're not going to approve this loan." Now we don't do that, but assets and bank statements tell so much about a borrower. I prefer to always have at least one bank statement if they're not needing any assets to close, if it's a cash out refinance or limited cash out or whatever, if they've put enough earnest money down. I prefer to have a bank statement, because if that borrower is, for example, if they're increasing their payment and they're overdrafting every month, Overdrafts are a pet peeve for me. And that tells me a lot about a borrower. Do they have undisclosed debt on that bank statement? So we need bank statements. I always say, even though you may show that they're not having to come up with any money, we need a bank statement, because that bank statement tells a lot about a borrower, and we are looking for sustainable borrowers.
So get the additional documentation, as far as bank statements are concerned. Okay. No more questions so far in the chat box that I can see. So this question, well, first, who on our panel does non-QM loans? No one?
I didn't hear you.
Non-QM loans?
We do on some of our portfolio products,
Okay.
but
Well,
not on a sellable loan at all.
not on the sellable. So what do you think is the perspective on non-QM and the outlook going forward for 2021 and beyond?
Well, there have been some significant changes in that in a qualified mortgage, and I'm still kind of studying up on that. So I think with the impact of COVID, I think we're going to see some of those tightening. But most of the time when I see non-QM, those are within a bank's risk appetite. You're not going to have that on a sellable product. So it all depends on the bank. What is their risk appetite? What do they think is going to be said when they get that infamous audit from the regulators? So that's kind of how we look at it.
Well, I don't have any other questions, and I don't see any other questions in our chat box. So I think we may be winding this down. If there are any questions that we didn't get a chance to get to, or if anyone thinks of anything that they would like for us to address later, please reach out to us and email us, and we will definitely get that information back to you. As everyone has said, please remember to check your institution's overlays and guidelines, the agency guidelines. Subscribe to the agency link so you can keep abreast with the guidelines as they come up. And we're here to help, so please reach out if you need us. Ladies, thank you so much. Thank you, Nan. Thank you, Jennifer. Thank you, Janice, and thank you, Regina. We couldn't have done it without you. So thank you guys, and thank you for taking the time. It's the end of the month. So finally, we have a few announcements. Our next webinar will be Thursday, March 18th at 1:00 p.m. And the NBA Chief Economist, Michael Bertatoni, will be the speaker. And registration for that webinar is now open on the Mortgage Bankers website. Also, our 2021 membership renewal and partnerships are also now available. Registrations for those are now available on the website. And also, guys, Great River Conference, 2021 Great River Conference is scheduled for August 17th through the 19th at the Peabody Hotel in Memphis. Early bird registration begins March 1st. So please, everyone, make plans to attend. Let's see, I think we have one more question, so I can't let you guys go just yet. Okay, we talked about PPP loans, but people want to know about SBA loans. How are they addressed during underwriting? I think that's going to be our last question. And I think everybody's somewhat has this. Anybody who wants to answer it, SBA loans.
When we document SBA loans, we want to know what's been used as collateral. It could possibly be the home that we're doing a refinance on. What is the collateral? What is the payment? What is the balance? As far as when we process the loan through the underwriting system with LPA, if you get an approve accept, you do not need a payment history on that SBA loan. The LPA has already made a decision on that loan based on the borrower's credit. So if it's an SBA loan that the borrower's had for a while, we do not need a 12-month payment history. We can go by our LPA results because they've already made a decision on that borrower's credit. But of course, we do want to know what was used as collateral, what is the payment, and what is the balance. And we're going to use that as a liability.
Thank you so much. Do you ladies want to have any final thoughts, any final words? Well, if not, special thanks to our Rockstar panelists, Jennifer, Janice, Regina, and Nan. Again, thank you all for attending. Until next month, have a wonderful rest of your day.
Thank you.
Thank you for having
Bye.
us.